Imagine this for a moment. While investors across the world were panicking, dumping silver, and watching prices collapse day after day, one man quietly walked in the opposite direction. No headlines, no interviews, no noise, just conviction. That man was Warren Buffett, and what he did between 1997 and 1998 is still one of the most misunderstood moves in modern investment history. At a time when silver was considered dead money, Buffett didn't just buy a little. He accumulated nearly 130 million ounces of physical silver. Not paper contracts, not derivatives, real, deliverable metal. At one point, his company controlled close to 1/3 of the world's available silver supply. Let that sink in. One investor, moving quietly while the market panicked, controlled more silver than most governments. This wasn't luck, this wasn't speculation, and it definitely wasn't emotion. This was a masterclass in contrarian value investing. To understand why this matters, you have to understand the mindset of the market at the time. In the late 1990s, silver prices had collapsed to around $5 per ounce. Investors had completely lost interest. Institutions had moved on to tech stocks and booming equity markets. Silver was seen as outdated, boring, and unproductive. The sentiment was overwhelmingly negative. And when sentiment turns that dark, most people run. But Buffett doesn't follow sentiment. He follows fundamentals. While others focused on price, Buffett focused on supply and demand. And what he saw was a problem the market was ignoring. Silver was being consumed faster than it was being produced. Industrial demand was steadily rising, while mining output and recycling were failing to keep up. Global inventories were shrinking year after year. That imbalance was not sustainable. Buffett understood something critical. When demand consistently exceeds supply, prices don't stay low forever. They correct. And when they do, the upside can be enormous. Between July 1997 and January 1998, Berkshire Hathaway systematically accumulated silver. They didn't chase prices. They didn't rush. They bought patiently on weakness. This was not a trade driven by headlines. It was driven by math. At an average price of around $5 per ounce, the total investment came to roughly $650 million. That may sound like a massive bet, but context matters. At the time, Berkshire Hathaway's net assets exceeded $30 billion. The silver position represented less than 2% of the portfolio. High conviction, controlled risk. That's how professionals think. This wasn't even Buffett's first experience with silver. Decades earlier, back in the 1960s, he had already studied the metal closely. He understood its role in monetary systems, its industrial uses, and how government policy could impact precious metals. He watched how silver was removed from coinage and how changes in monetary policy created opportunities for those paying attention. So by the time the late 90s arrived, Buffett wasn't reacting. He was executing a plan informed by decades of observation. Now here's where it gets interesting. Buffett has famously criticized gold for years, calling it unproductive. He argues that gold doesn't generate cash flow, doesn't pay dividends, and only increases in value if someone else is willing to pay more for it later. Silver, however, was different. Silver had utility. It was essential in electronics, medical equipment, photography, and industrial manufacturing. It wasn't just a store of value, it was a consumable commodity with real-world demand. That intrinsic utility is what made silver pass Buffett's value test. When Berkshire took delivery of the metal, they didn't want paper exposure. They wanted physical silver delivered and stored securely in London. This wasn't a short-term speculation. This was ownership. And when the position was finally disclosed publicly in early 1998, the market was stunned. Silver prices jumped. Analysts scrambled to understand why the world's most famous stock investor had made such a move. But the answer was simple. The numbers made sense. Buffett didn't care about narratives. He cared about imbalance. He held the silver for years, through volatility, through market cycles, through noise. He didn't panic. He didn't chase momentum. He waited for the fundamentals to normalize. By the mid-2000s, Berkshire gradually exited the position. The exact profit figures vary depending on the source, but estimates range from nearly $100 million to well over $200 million. Either way, it was a profitable trade. Not Buffett's biggest win, but a disciplined one. What's fascinating is what happened afterward. Silver prices continued to rise and eventually exploded during the precious metals bull run, reaching nearly $50 per ounce. Had Buffett held longer, the gains would have been astronomical. But he didn't. And that tells you everything you need to know about his philosophy. Buffett is not a speculator. He is a value investor. Once the imbalance corrected and the margin of safety disappeared, he exited. He didn't try to time the top. He didn't get greedy. He respected the data. That discipline is what separates legends from gamblers. So what can we learn from this trade? First, fundamentals matter more than price. Price tells you what the market feels. Fundamentals tell you what the market is missing. Second, being contrarian only works when you're right. Buffett didn't buy silver just to be different. He bought it because the data supported it. Third, conviction must be paired with risk management. Even with high confidence, Buffett limited his exposure. That's how you survive long-term. Fourth, patience is a weapon. He held for years, not weeks. He allowed the thesis to play out. And finally, knowing when to exit is just as important as knowing when to enter. Most investors fall in love with their winners. Buffett didn't. Now, why does this story matter today? Because markets change, but human behavior doesn't. Fear and greed still drive decisions. Supply and demand still dictate price. And opportunities still emerge when the crowd looks the other way. Today, silver is once again under pressure from structural imbalances. Industrial demand has surged due to technology, renewable energy, and advanced manufacturing. Silver is critical in solar panels, electric vehicles, semiconductors, and medical devices. At the same time, mining supply struggles to keep pace. New projects are expensive. Recycling helps, but it's not enough to close the gap. This doesn't mean history will repeat exactly. Markets are different, conditions are different, but the principles remain the same. Study the fundamentals, ignore the noise, manage risk, be patient, and think independently. When Buffett bought silver, people thought he was crazy. A billionaire investor buying a beaten-down commodity that everyone else had written off. It didn't fit the narrative. But Buffett has never cared about narratives. He cares about numbers. You and I don't have Berkshire Hathaway's resources. We can't buy 130 million ounces of silver, but we can adopt the same mindset. We can learn to analyze supply and demand. We can recognize fear-driven mispricing, and we can make decisions based on data instead of emotion. That's how real wealth is built, not through hype, not through shortcuts, but through discipline, patience, and understanding how markets truly work. This is Riker Dean, and this is what thinking like a legend actually looks like.